Welcome, everybody, to my second workshop in a financial series with the Fairfax County Public Library. I'm really very happy to be here, and I thank Renee and the library for giving me this opportunity to reach out and help people, especially during this crazy, uncertain, unprecedented time of COVID-19. Before we begin, I always have to put out a disclosure that this workshop is for educational purposes only. I am a financial advisor, a financial planner, but if I were giving custom advice, custom planning, I could not do it in this venue, right? Due to compliance and all of the FINRA SEC regulations. So I'm a teacher today. Ask as many questions as you like. I'm not an accountant or an attorney. So always, if you have questions about that stuff, always go and talk to your other professional advisors. All right, today we're going to talk about the stock market and protecting your assets. And you know, when I sat down to put this together, I realized that really protecting your assets is a very broad term. And if I had to put it into something that's easier to talk to and more quantifiable, I would really be talking about market volatility, the ups and the downs in the market. Clearly, we've seen extreme volatility due to the pandemic, and people are losing value, and it makes them want to protect the amount that they invested, protect the growth that they may have attained. So protecting your investments is a relative term, and you've really got to understand market volatility. Now, you know, hard to not be emotional, right? Especially now, even myself. It's uncertain, unprecedented, but because I'm thank goodness, a numbers person, right? I have a background in technology and then moved into financial services, so I'm clearly more data-driven. But we're going to talk about strategies, whether you're more, emotional or more pragmatic, more practical. We're going to talk about strategies, how to deal with market volatility, and if it's suitable, how to basically eliminate it from your portfolio. Now, a lot of this has to do with planning, okay? And some of you have a plan, and you should stick to that plan if it's a good plan, if it's been updated. But if you don't have a plan, we're going to talk about some of the things you can do to build a plan, create a plan, right? Ben Franklin had a saying, a failure to plan is planning to fail. And boy, oh boy, I could not agree with him more. We're going to wrap up and summarize what we've learned. And then, of course, we'll open it up, as Renee said, for some questions and answers. All right, let's get started. So what is market volatility? Well, very simple. It's big swings in the stock market in either direction. And the common stock market indexes are the S&P 500, the Dow Jones, things like that, right? A broad brush view of stocks, of companies that sell their stocks to investors. Now, volatility is really considered a change or a rise or a fall of more than 1%, not per day, but pretty much over a given time period. And depending on the nature of the underlying index or the stock market that you're tracking, really tells us how long we need to see those ups and downs. But at the end of the day, you really want to understand what a correction is. And a correction is whenever the market rises or falls more than 10%. It could be in one day, it could be in a week, A correction is a big drop in the market. corrections usually are per day, a 10% or more drop in one day. But if it's 2 days, it's probably going to be still considered a market correction. Now, interesting, if you understand anything about the market, the market always prices in fear and worry before the data actually hits. And we attribute that to the media mostly, right? And now with the internet, we just get information so much quicker than we used to. And that gives us the opportunity basically to respond emotionally before we even see the numbers. But with the pandemic, of course, we saw the numbers pretty quickly. And so I think the fear was warranted. The markets tend to precede, just like fear precedes the data, market declines precede economic decline or recession. We see the markets move, and now I think we're all getting ready to experience a recession. They can last anywhere from 2 or 3 months to 4 years, but on average, recessions will last 12 months, 12 to 18 months. Just to get a little perspective here, if we look at the Dow Jones Industrial Average since 1915, oh my goodness, if this doesn't spell volatility or roller coaster, I don't know what does, but this is over 100 years ago. I can put these clearly. We know right here is the Great Depression in 1929, right here. But in my lifetime, and probably many of you on the call right now, I've been investing since I was in college. I made my first living in technology, but I was always invested in the market. I grew up blue collar, middle income, and got a student loan for $2,500, and I was like, wow, I've never seen this much money. I think I'd like to invest it in the stock market. And I did that and then I went to work, of course, to make up the money, waitressing and things like that. But when I graduated, I had 10,000 in the market. That was 1984. So in 1987, what we call Black Monday, believe you me, I was watching it very closely and responding to it for the first time in my investing career. And if you remember, this was all about when we were starting to automate trading, as opposed to going from manual people on the floor of the exchange yelling orders to buy or sell. We went to electronic trading, and there was a big disruption. This is clearly the tech bubble around 2000, 2001, the dot-com era, and the bubble that followed. This is the housing bubble, what we call the Great Recession, 2007, 2008. And here we are today. We've had an incredible run over the past 12 years, but here we are. This is the pandemic right here that we're here to talk about. And this is the volatility. Here I'm actually zooming in on this year, the year of COVID-19. And we were pretty much enjoying the returns of 2019 and cruising right along. And then right about here, February 23rd or so, we got the first news of the pandemic and the virus. And we weren't even sure if we really had experienced it in the US, but the market took a big drop here, went from around 29,000 down to 25,500. Okay, that was clearly a market correction. Then as we got more information, well, we pretty much bottomed out around March 22nd. That's a 10,000 point drop in 3 or 4 weeks. Since then, we've started to climb back and we've staggered a little bit, but this is just a close-up look at this year. Now let's think about this. What is your reaction and why are you here today? I'm guessing you are invested in the market, or you know somebody who's invested in the market. You've got some money in the market. Are you panicked, or are you calm, or trying to be calm and looking for a perspective on it? How much do you have in the market? A lot, a little? What's your exposure? Are you more stocks than bonds? You know, what's your asset allocation? If you don't know this, you're definitely going to enjoy today, because we're going to talk a lot about asset allocation and how that's really the one thing you can do that has the greatest effect on how long your money will last, is how you allocate your assets. What's your age? Are you 20s, 30s, 40s, 50s, 60s, nearing retirement, already retired? How do you feel about risk? It's funny, but age, we should, I think, conform to certain attitudes towards risk, but oh my goodness, it's not required. You know, I know millennials that are highly risk averse, primarily because they lived through the Great Recession. So I know people in their 60s and 70s who love to invest in the stock market. So you really have to consider your age, how much risk can you tolerate versus how much risk should you tolerate, and what's your time horizon? How long to retirement, or how long before your children go to college? You know, whatever that goal is to grow your money, you have to figure out, when do you need it? When do you plan to retire? What's your investment plan? Do you have one? And are you following it? Our first workshop last week with the library was really about financial wellness during COVID. And it's hard for me. We've got a lot of information to cover, but I can tell you it's hard for me to talk about something as emotional as a pandemic without thinking about emotional wellness and financial health and how they go hand in hand. If you're emotionally or physically unwell, then you're going to have trouble with this presentation. So I would say get a handle on your overall wellness, and then you'll be better able to understand some of the things that we're discussing today. Now, I guess the extent to which I want to protect my assets from decline is really based on, am I willing to accept volatility? Do I understand it? Am I educated? Now, one of the reasons Renee mentioned, you know, I got into this was I wanted to help others, and I really firmly believe, at least my mission is, you've got to make informed, educated decisions about your money. Do you understand volatility? Do you understand how to accept it, how to work with it? And you can even use volatility to your advantage. So, strategies to deal with it. If I accept market volatility, that doesn't mean I accept losing money. So what do you mean, Lynn? What are you trying to tell me? Well, okay, first, you really do need an investment plan. And once you have it, you need to stick to it. And you need to come back and revise it every year, every significant life event, birth, death, marriage, lose your job, things like that. Now, I would love to know how many of you today, and I guess we'll talk about it later, but the buy and hold is truly the best strategy you can have. But if you shouldn't be in the market based on your age, years to retirement, does risk keep you up at night? You know, this is an important point to grasp. Then buy and hold doesn't make sense, because you really shouldn't be in the market after all. Or you shouldn't have half of your money in the market, maybe only 10% in the market. So buy and hold is, we're going to talk about it, but you really need to put into perspective, should you be in the market in the first place? And if you should, based on your goals, your goals and all the things about you that make up your investment profile, then you've got to find a way to stay in the market. Okay, and don't jump in and out, and you'll see why. So you have to be disciplined. If you were on a savings plan and an investing plan, so maybe you're putting $50 a month into a savings account for emergencies, and maybe you're putting $100 a month into a brokerage account. When the market is volatile, the best thing you can do, second to being allocated properly, is continue to invest and buy those stocks and mutual funds when they're on sale. You have to diversify. You can't own all large cap. You got to have some mid and small. You can't own all long-term bonds. You should have some mid-term and short-term bonds. You can introduce annuities and life insurance, their investment assets, into your portfolio. You have to diversify. It is the only way to reduce market risk. Basically, market risk is volatility. Allocate your assets based on your age, goals, time horizon, and tolerance for risk. We're going to talk about these. These are actually core themes today. Goals, time horizon, tolerance for risk. Rebalance. This is something that, there's a lot of people that invest on their own, to do it yourselfers. But I will guarantee you, and studies show, that the people that invest on their own do not rebalance. And this is fundamental to all financial advisors. But when you're doing it yourself, you really don't even understand it, let alone do it. You always have to keep your emotions in check. You have to be aware. We're not robots, we're emotional. But again, if we can get a handle on our emotions, then we're in a better position to make, informed, educated, rational decisions around our investments. Protecting your investments does not mean how to get out of the market. Protecting your investments can be simply doing nothing, staying in the market, staying invested, if you can. We're going to go over history. I'm going to show you some volatility and how emotion can really cost you some money. And as always, investing on your own, I don't have a problem with that, actually. I don't think investing is rocket science. I think planning is more important than investing, and that's why I'm a certified financial planner. I think that it's great if you can have a solid financial plan that's suitable to you, and then you just have to take it and execute it and check in with your financial professional for revisions and reinforcement to stick to it. All right, market cycles and investor behavior. You know what? Market returns are unpredictable, but market cycles are very predictable. And they just go round and round and round. You're in an economic expansion, the market's doing great, it's what we call a bull market, right? People are jumping in and buying high because they have FOMO, fear of missing out. And oh my gosh, everybody's making money, I need to jump in. So they jump in almost at the top of the market. And then slowly but surely, a recession comes around and it becomes a bear market. And then you're afraid of running out of money. And so you sell. So you're buying high, selling low, the market bottoms, and then you just come right around. That's emotional. It's emotional trading. The best approach, have an investment plan and stick with it. But purpose of this is to show you that market cycles are predictable. And unfortunately, investor behavior is too. And that's really what we're trying to change here. Now, market declines may not be predictable, but they sure are regular. This table shows us how frequently the market declines in the Dow Jones Industrial Average since 1900. We are looking at 120 years here. And about every 3 years, I'm sorry, 3 times a year, we get a negative 5% or more decline in the market. The average length of that decline, 47 days. The last occurrence before now was October 2014. And before that, 2013. Before that, August. We get a 10% or more decline about once a year. And that lasts 115 days. 15% or more once every 2 years. 20% or more once every 3.5 years. The average length is about a year. Prior to today, this was the Great Recession, March 2009. The one prior to that, if you remember on one of the initial slides, was the tech bubble, the 2001 tech bubble. So 3 times a year, 1 time a year, once every 2 years, once every 3.5 years. When I look at that, that tells me it's really impossible. If I'm looking at a 5% decline, is it going to continue? Or is it just going to come back in 47 days? This slide, you just don't know. You don't have a crystal ball. Okay? Now, if you've already had a 15% or more decline and it's over 216 days, well, maybe a 5%, isn't so bad. It won't last long. But how do you know? We've never had a pandemic before. Unfortunately, as I said, investor behavior is predictable. TSP, Thrift Savings Plan, all of our federal workers all over the country. In March of 2020, these statistics are from the Thrift Savings Plan. There was a flight to safety in March. $15 billion moved from the C fund, which are common stocks, and the L fund, which are target date, over into the G fund, treasuries, the only guaranteed fixed return that there is. A little bit from the F, a little bit from the S, and a little bit from the I, the international. But predominantly people moved out of the stock market into maybe a 3%, 2 or 3% government fund. This one, target date funds are already balanced with, depending on your retirement year. Why would you go from here over to here? It's irrational. Okay. These people who flee the market, and not just TSP, it's happening all over, but I was able to get some real numbers to put to it. They're going to miss out on the recovery, and their investments will never catch up. And that's a bona fide fact. If we want to put some numbers to it, we're looking at growth of $10,000 invested since January of 1980. So that's 30, 40 years. That's 40 years of investing. Now, if you did a buy and hold, that 10,000 would be worth over 700,000. That's incredible, right? That is just incredible return. If you missed the five best days in those 40 years, meaning you panicked, you sold, and then you got back in, you would have lost about $250,000 from missing the 5 best days of market performance over a 40-year period. That's just one day every 10 years. If you miss the 10 best days, oh goodness, you got about half of your money. If you miss the 30 best days, and if you miss the 50 best days, this is somebody who's just jumping in and out of the market once a year, trying to time it. So, you know, there's just nothing good can come from trying to time the market. Nothing. Another interesting table is, you know, even if it's not fear-based, you know, we sell when we're afraid, but we also sell because we think we're like a hotshot investor and we really think we can time the market. So, you know, there's 2 primary reasons why people sell. It's either fear-based or, you know, it's crystal ball based, right? So an average investor, we're not discussing fear here. We're talking about the person who's trying to time the market. So we look at $100,000 over 20 years, and a person who tries to time the market is going to make $120,000 less, basically, in stocks. They could have a much higher return. The average return over that period was 7.2. If you tried to time it, you made 5.29%. It's not in this table, but if you were dealing with bonds and you tried to time the market, which really has to do with interest rates, you know, trying to figure out when interest rates are heading up and when they're heading down. Look at this difference, 5% versus less than 0.5%. So we really want to be more rational. Some of the key points to remember are, and this is if you're retired today, right, during the pandemic, or you're retired during any market correction, you've got to try and stop taking distributions from the market. If you have alternative accounts, other forms of income, use those. Look for ways to supplement your income if you're still able to work a little bit. Definitely cut back on expenses and only spend what you need to get by. A lot of people are saving money now, fortunate enough to work from home, but they're just not going out. So they're actually saving more. That's a good place to be. But taking income when the market's down and you're retired may very well cause you to outlive your money. And there's many statistics to show that. If you're near retirement, you've got to check your asset allocation. Should you be in the market? Are you in the market with the right amount or the right ratio of stocks to bonds, growth to income? Don't over allocate, and always remember to rebalance. If you're more than 5, I'd say 5 to 7 years out, don't worry. Do nothing. And continue to invest regularly if you can. The market will come back. Cycles are predictable. Let's talk about investment planning. You're either a saver / investor or you're a spender. You know, and if you're in your 20s to 40s, you're going to be allocated to stocks, more stocks than bonds. Your balances will drop during a bear market and rise in a bull market, but stick with your plan. Keep investing regularly. If you're spending in your spending years, your retirement years, you must preserve your wealth, because you are living off, or you soon will be living off, your savings and investments. And somewhere around the 5 to 7 year mark, you've got to begin transitioning from growth to income generating investments. You've got to dial back, reduce the amount of stocks and stock mutual funds and equities that you own, and build a portfolio that's really going to be more resilient, more diverse. Again, asset allocation is essential in both places. So, critical for investment planning, define your goals. Are you saving for college? Saving for a big vacation in 5 years? Saving for retirement? What are you planning for? How much will you need? How much can you save each month? What's your tolerance for risk? What keeps you up at night? I always used to ask my clients, so if we do this and you get a statement 2 months from now and your investments are down 10%, how will you feel? And if they say, I'm going to call you, Lynn, when I say, okay, then we're taking too much risk. You have a low tolerance for risk. What's your time horizon? 30 years, 20 years, 5 years? Based on 1 through 6, you're going to do an asset allocation. Then we need to assess the probability of attaining your goal, and you need to stick to it and rebalance. Let's take a look at the buy and hold strategy. Okay. Quite simply, if you look at this graph, year 1, we look at the annualized annual returns. Market goes up, market goes down. The market goes down, you see the red. If you look at the market on a year-by-year basis from 1872 to 2018, my goodness, that has got to be 150 years or so. The largest annual return was 53%. That was back in the 1920s, about right here, 1932, yeah. Minimum, or the most the market lost, 37% in 1 year, and that was the Great Recession. Standard deviation, the average return, 8.4%. Standard deviation is a technical term for volatility. If you have a standard deviation of 18%, if your portfolio has a standard deviation of 18%, I'm right down here, that means on any given day, any given month, any given year, your investment could go up on average 18% or down 18%, plus or minus 18%. That is a volatility measure. Now, if we broaden our buy and hold from 1 year to 5 years, you can see that there's less red because we're looking at a rolling 5 years. So you do years 1 through 5 and you get the results. Then you do years 2 through 6, 3 through 7, 4 through 8, and you go through 150 years and say, if I buy and hold for 5 years, I'm only and I use historical data, I would have only experienced declines here where I see red. Now, my average return over any 5-year rolling period is 28%. My average return is 7. Standard deviation is greatly reduced. If I buy and hold 10 years and I look at a rolling 10 years, I see even less red. If I buy and hold for 20 years and I go back 150 years and I start in any year and invest for 20 years, I never have a negative loss. So the risk of losing money diminishes the longer you stay in the market. The US stock market has never lost money over any 20-year period. That's a picture worth 1,000 words. Now, if we just take those average real returns and we annualize them based on the 1 year, 5 year, 10 year, and 20 year, you can see that over here in 20 years, your average annualized returns are all positive because this is 0 and this is negative going down. So in the long run, stocks have always and will continue to deliver strong positive returns. But if your investment horizon is short, your money is better suited in cash and bonds and annuities. If you invested $1,000 in 1949 and held that in the market for 70 years, that $1,000 would grow to $1.5 million. Now, adjusted for inflation, you know, the cost of bread in 1949 versus the cost of bread, a loaf of bread in 2019, et cetera, your money has gained, it's doubled 143 times. 1,000 became, actually that's, I think, 14,300%. Yeah, pretty amazing stuff. Let's jump into asset allocation. You know, very simply, it is making sure that you divide, you mix up all of your investments into the different asset classes. Mutual funds, ETFs, life insurance, annuities, stocks, and bonds. That is asset allocation. It is the most important thing you can do. If all of your money is in the stock market, you're not, you may be diversified, you may own large cap, mid cap, and small cap, but you have not utilized asset allocation to help you achieve your goals. Okay, we have a few rules of thumb. Growth. How much of my money should be in the stock market and equity mutual funds? Well, take your age, subtract it from 100, and that is the rule of thumb that still holds up. That should be the percent of your investments that should be in the stock market. How much income should I own? Income-oriented investments. Well, that's basically 100 minus the growth or your age, the percent of your portfolio that should be in fixed guaranteed income. So it's not uncommon for people that are younger to hold 60 to 90% in stocks, and people that are older, maybe 60s to 80s, clearly they're going to be more income focused, not rocket science. This is one of my favorite slides. I call it SLY. How much risk should you take? I kid you not, everybody I sit down with, I pull this out. The SLY factor: safety, liquidity, and yield. You can only choose 2 out of the 3. For purposes of example, I'll say most people, they want to talk about safety and access to their money. And they're willing to accept the yield that comes with it. But rest assured, I get plenty of people that want the safest investment and they want the highest yield. So they want to be in, you know, CDs earning 8%. Well, you just can't do that. You have to stay here. The more safe, the more liquid the investment, the lower the yield. The less safe, the less liquid, the higher the yield. Choose the 2 that are most important to you. And then that'll define the third category. Safety, liquidity, and yield. You can only pick 2, and then you have to accept the third. We're going to quickly run through asset allocation. It's how, you know, and it's very simplest sense. We're looking at stocks and bonds and cash. So if you're investing for income, you're seeking income, you are risk averse, you don't want to lose your principal, you're willing to accept lower returns, and your time horizon is short to midterm, okay? Maybe like 1 to 5 years. Again, and this would be somebody who's looking to retire in 1 to 5 years. They should be in bonds, or maybe 20% bonds, 80% bonds, 20% stocks, 70% bonds, 30% stocks. People that are looking for a balanced approach, well, they want growth and income, and they're probably going to be people more in their probably 40s and 50s, even 60s. They're willing to accept some risk to principal. They do want to see moderate, decent returns, not the highest, not the lowest. Their time range is mid to long. Probably, I would say 15 to 5 years from retirement. You can have 40 stocks, 60 bond, half and half, 60 bond, 40%. 60 stocks, 40% bond. The third is growth oriented. You want your money to grow. You can handle high risk, you want the higher returns, and you can tolerate market volatility. If you cannot tolerate market volatility, then you should not. It doesn't matter what age you are or what kind of returns you want. If you cannot tolerate it, then you should not be in the market. Okay? When you're oriented towards growth, you have much more in stocks, the red, than you do in bonds. And you should be a long-term investor. Rebalancing. So what is rebalancing? Let's say your original asset allocation is right here, the original mix. You're 10% stocks, 30% in growth and income, 25% in balanced funds, 35% in bond funds. Okay? This is somebody probably in their 30s or 40s. The stock market drops 50%. I know that's a huge drop, but in this example, after the market fluctuation, I really should say market crash, the stock portion, if the stock market goes down 50%, my 10% goes down 5%. Oh, I'm sorry. This is the mix for somebody that's probably much more, not younger, but older, right? Maybe 60s, 70s, 80s. 10% of their portfolio goes down by 50%. It's now 5%. Everything adjusts. Every asset class adjusts. So now you have more exposure to bond funds than you do to equities. If you really want to maintain this, you need to sell. You basically need to adapt and trust the allocation enough to reallocate from this back over to here. So you're going to liquidate some of your bond funds and some of your equity balanced funds. You're going to liquidate some of these in order to invest 10% in stock and 30% in income funds. I hope I'm not confusing you. I can certainly take questions on this afterwards, but if you trust your plan and your asset allocation and you hit a big correction in the market, you really want to come back and reallocate so that you are at your original mix. You will, if you stay invested, and when the market does come back, you will not only recover, but you will recover quicker when the market comes back up. Okay, so we've dealt with volatility. What if I want to reduce it? Well, I could do a whole series on investments that are not correlated to the market. If the stock market were considered 1.0, then, and I have an asset that is correlated to the market at 0.5, if the market goes up 20%, my asset goes up only 10. 50% is high. If the market goes down 20%, I only go down 10%. So you see commodities, oil, wheat, also sugar, corn, all types of commodities. They have a very low correlation to the market, right? The market is invested in companies. Commodities are invested in commodities, products that we buy and we trade in. Bonds. Bonds are correlated to interest rates. They've got nothing to do with the market. Interest rates go up, the price of your bond goes down, right? They're not correlated. That's why our asset allocation is generally stocks and bonds. But I would put some commodities in there. I would have some rental property, not at all. People, except maybe during the pandemic, of course, people usually can pay their rent. The people that are living paycheck to paycheck, unfortunately, 70% of our country live paycheck to paycheck. They're not the people that are invested in the market. They're really not the people that are probably attending this presentation today. So during market corrections, people are still employed. They tend to still be able to pay their rent. Whole life insurance, whole nother subject. Whole life insurance is not correlated to the market. You get dividends from the insurance company, New York Life, Mass Mutual, right? You can definitely reduce market volatility by diversifying across low correlation assets. Dividend paying stocks, this is a big one. If you're in the stock market, why not focus on investment grade companies that pay a dividend? This can actually make the difference of 2 to 3% more return during market declines. Again, we've got an unprecedented time here, and only time will tell if some of our larger companies start reducing dividends. But I have to tell you, when that happens, that'll be like the sky falling. Reallocate bonds to indexed annuities. This is a whole nother course. Bonds give you guaranteed income. Well, it's not really guaranteed now. It's based on the claims paying ability of the company, but you tend to buy bonds to create income. It's a very traditional way, a traditional investment for people who are retired. But annuities will give you guaranteed income. They protect you from inflation, and you never lose a dollar of your principal. Eliminating market volatility, you really should only be looking at eliminating market volatility as you near retirement, okay? And I never really suggest putting all of your money into one thing, but index products are built, such as annuities, are built to never go down and to only go up. They basically have a cap and a floor. Here the cap is 14% and the floor is 0. So when the market goes down, you do not earn a penny, but you do not lose a penny. And then when the market goes up, you participate in that year 4 26% gain, only up to the cap, 14%. So if it's under 14%, you get the entire gain, right? 8, 3, 13, 3. Year 10, the market went up 23. Your index product got 14. Indexed products allow you to participate in the market without any risk of losing your principal. These products are called principal protection programs, and again, when I thought about protecting your principal, it's really insulating yourself from market volatility so that you never lose the money that you invest. And outside of CDs and very low paying treasuries, you may want to look at index products because it's really like getting investment grade returns, but with investment grade quality with junk bond returns. They're offered by insurance companies. You can get, AAA annuities that are offering 6 to 7% right now. Okay, is the worst over? Well, we have an index for everything. I kid you not. And there's a volatility index called the VIX. And it peaked a month ago. The market stress is going away. If we believe the numbers, the market stress is going away. Now, this is a very global perspective. This is countries with higher than 5% growth rate in the daily number of confirmed COVID cases. I would just take this with a little grain of salt, because the countries that saw it early and could react are going away, right? They're going less than a 5% growth rate because they have it under control. The US, this is global. In the US, if we just look at the US, we might actually be more, I think, in this stage. So it's hard to say. From a global perspective, yes. The overall global market stress is going away, but in terms of the US market stress, I don't believe we're here. I believe we're probably somewhere around here. So I don't mean to be misleading about this. So let's recap. What should you do during the pandemic? Oh my goodness. Well, really, really take a step back and educate yourself on financial wellness, overall wellness. Where are you? Physically, emotionally, spiritually, financially. There's so many wellness factors. Socially, we're at about a 0 wellness right now because we can't socialize, but educate yourself on overall wellness and financial wellness. And of course, health takes precedence over wealth. Doing nothing is really doing something if doing nothing is based on the data and not fear and paralysis. Continue to save and invest if you can. If you can't, that's okay. Revisit your plan or create a plan. Let's just really utilize this downtime to really improve ourselves, not just financially, but I would say across all of the wellness factors. After the pandemic, what do? I say we see above. Go back to step 1. What we do during this pandemic with respect to the market, or really with respect to anything really, I mean, it'll change forever the way we have lived, but how we deal with it, how we deal with the stress in the market and outside of the market really doesn't change. Warren Buffett, one of the greatest investors of all times. The market's unpredictable. Over the long term, there's only one direction that it goes up. A correction or a crash is not such a bad thing for long-term investors. When stocks fall, you want some financial flexibility. If everybody's selling and you don't have to sell, don't follow the herd. Avoid the herd mentality. Don't panic. Stay calm, stay invested, and stay well. All right. Goodness, I apologize. I was longer than I expected, but I'm happy to stay on the phone and take questions as long as you like. So I'll turn it over to Renee.
Hi everyone. So if you have questions, you can either type them in through the group chat or ask them. Well, Lynn, I think your program was so wonderful.
Thank you, Renee. I'll wrap up and just say one of my favorite personal Lynnisms or quotes is, rest assured, if you don't make informed educated decisions about your money, somebody else will be happy to decide for you. Help is just a click or a call away. Here's my email. I'm sure Renee will share it with you. I've got a website. You can subscribe. You can ask me a question if something occurs to you after this workshop. Schedule a meeting. You can register for other workshops, replay this one. As I said, I think Renee and I will be working on possibly some other workshops in the future, so stay tuned. And every Wednesday, I am online live from 12 to 1, and that's a time when I love to let people call in and ask whatever questions they have. I call it Wealthy Wednesdays, and it's really a play on health and wealth, right? You can't have one without the other. So I welcome all questions. Thank you very much.
All right, thank you, Lynn, and thank you everyone for attending. As Lynn mentioned, we hope to bring her back for a series on financial literacy. We are adding virtual programs to our schedule left, right, up, and down. So please go to our website and click on events and then digital programs to see what we're offering. Thank you, everyone, and have a nice day.
Thank you, Renee. Thanks, everyone.